Good morning and welcome to today's webcast, Understanding Tax Changes for Fringe Benefits and Other Expenses. Before we begin today's presentation, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams. Susan Mehlman, Director, National Tax and Compensation and Benefits, and Gary Stirbis, Director, National Tax Controversy and Dispute Resolution. And with that, Gary, I'll turn it over to you to get us started.
All right. Thank you, Emily. This is Gary Stirbis, and I want to thank all of you for attending. One of the things we really want to accomplish today is with new legislation, there's obviously a lot of uncertainty. So we want to highlight what guidance we have out there, try and really get you prepared for the way the IRS would look at it. A large portion of my practice is representing clients in front of the IRS. So I've been through a lot of payroll tax examinations, understand kind of the thought process of how they think about this. And now that we have the new legislation, we have guidance out there on some of the different critical areas. We don't have final regulations on a lot of the areas, but we do have some pretty good notices. And so we're going to really highlight that for you, try and get you prepared, and then get you kind of moving forward as you get into this upcoming tax season. As far as the overall agenda, what we really want to do is highlight the critical rules that have changed with regards to entertainment and then business meals, both for clients and employees, including recreation, as there's some nuances in that area. Also, cafeteria facilities that are meals employed and provided by the employer. There's a lot of misinformation out there. This is a high scrutiny area for the IRS, and so I'm going to dig in a little bit deeper on that, what kind of guidance they've given us, how they've approached that in practice, and how to protect yourself if that's something that you have in your business. And then qualified transportation fringe benefits. Susan's going to cover that in a fair amount of detail. There's a good notice out there that talks a lot about the detail. Qualified moving expenses, we'll cover that a little bit lighter. It's a fairly straightforward rule, but there is some interim guidance as well. And then what we really want to do is give you some practical business application ideas in order to protect yourself in the event of IRS scrutiny. And then we're going to talk a little bit, or I'm going to talk in more detail about payroll tax examinations, and then Susan and I will talk about, what we're seeing with the IRS and how they approach these particular issues, and hopefully help you in the future. So with that, Emily, it looks like we have a polling question right off the bat.
All right, our first polling question. How familiar are you with changes to deductions for meals and entertainment expenses and other fringe benefits? And your options are very, I'm up to speed, somewhat, or not at all. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And if you're having any trouble seeing the polls, try refreshing your browser with F5. We'll give everybody a few more seconds. And let's take a look at the results. Gary, back to you.
All right, thank you. And this doesn't surprise me, so I think it's good that the audience is somewhat. And I think what we really want to lie out there for you is the basic rules. And I think it's always one of the things you have to do is look at where were we and where are we going forward. And that's what I really want to do, because I think, we have to retrain ourselves because it's a different paradigm. I think under the pre-tax reform, most taxpayers would lump all meals, all entertainment in one large bucket. It's 50% deductible. And that in the code was pretty well established like that. Certain things were non-deductible, and then certain things were deductible. We always had this catch-all bucket under Section 162, which is if things are ordinary and necessary under 162, we're going to lump it in that, and then you had restrictions under Section 274 that says, okay, we're going to limit that. I think the big change in this area, more than anything, is really the entertainment section. And so this is, I think, a big change for our client base. And the code says entertainment is any entertainment, amusement, recreation. But then if you get into the reg and the real-life examples, we're talking about taking clients to theaters, having a membership at a club, golfing events, sporting events, hunting trips, fishing, etc. I think a lot of times our clients might have let's use reason by analogy, have a suite at, I live in the Northwest, the Seahawks season tickets. And by clients is a good networking event. There's also meals served at that. Under the new regime, that entertainment aspect is completely non-deductible. You look at the bottom of that slide, it says there is a component that is deductible under 274E. That's true, but it's a very, very specialized, nuanced area. So I think that's one of the more sweeping changes. And then with the new rules, a lot of business meals are still deductible, but you're going to have some that are 50%, a small segment that could be 100%, and still the non-deductible meals. And one of the things that I encounter in my practice a lot, it's not whether you follow the literal requirements of the code section, especially 274. In theory, you followed it, but you really couldn't document it. And I think that's where Susan and I see the most missteps with our client base, and that is, did you meet the requirements when the IRS actually comes in the door and wants to see how you manage this on your tax return? And that we will try and highlight. So I want to talk about kind of the overview of the changes that we're seeing. And really, these are the big rules, and then we're going to get into the different ones. But one of the things I want to tell everyone, if any of these hit your business, what you need to know is there is almost a specific notice on each particular one. And so we will highlight that. And then again, it's interim guidance, but the service has actually done a pretty decent job. So under Section 274, like I said, essentially no deduction allowed for entertainment with or without clients. That does not mean that certain meals can't be expensed if there's entertainment involved, but there needs to be some very specific rules around that and how you go about that. The deduction for employee cafeterias, it went from 100% to 50%, and then it fully sunset in 2025, meaning it'll no longer be deductible when we get to that time frame. The de minimis food and beverage has been reduced to 50%. And we've had a lot of questions on qualified transportation fringe benefits and employee parking. Susan's going to go over this in detail. Generally, there should be no overall impact to the employee, but there are some requirements that could create compensation to them. and there's some limited deduction for employee commuting costs. And then also there is an allowable deduction for the employer for employee commuting, but there has to be for the safety of an employee. We have a lack of guidance in that area. And then finally, on the moving expense, for those clients out there and taxpayers that have a lot of employee moving expenses, I think this is going to be a significant issue because the income exclusion is no longer there, meaning employees are going to have to take this into income, which is, could be prohibitive in a recruiting sense. So I think we'll see some workarounds on that in general. What I really want to talk about is for you to get takeaways and a little nugget to take out of this is what guidance does exist. Like I said, under new legislation, we have limited guidance, and that's mostly in the form of notices. But if your business has any one of these areas, I think it's worth your time, if you're a CFO, even an owner, or implementing policies for your business, to take a time to go through these separate notices. And so I'm going to walk through them. Notice 2018-75 is the exclusion from income for qualified moving expenses. And without getting too in-depth in the rules, it really gets under Section 132G2 and Section 217. And what that notice does, it really lays out the statutory framework for the idea behind limiting that tax benefit. I think that's an easier read in the fact that it's a more straightforward rule. I think the notice that most people will want to read just to get a better sense of it is 2018-76, and that permits the 50% deduction for certain business meals, but it also articulates the rule under Section 274 that disallows essentially almost all entertainment, amusement, or recreation expenses. Then it carries back in and says, okay, we disallowed that, but we're going to tell you what requirements you can still deduct employee business meals, which they are still deductible if you meet certain requirements. And that notice right off the bat specifically states this is transitional guidance. There was a notice and comment period. I believe that ended in December of 2018 for proposed regulations, but for those of you that have to work with the IRS on a day-in, day-out basis, they're completely overworked, understaffed, and so when that actual final guidance will come out, it could be a while, but taxpayers can rely on this, and it's very clear in the notice this is what we have thus far, although even though those notices have some gaps in them. 2018-99 is for qualified transportation fringe benefits. Again, Susan's going to get into detail of that. Has some very specific rules on how allocation should work, how taxpayers should address this, what is includable, what's excludable, very good summary and more details. Another very detailed one is a Chief Counsel advice, 2018- and it's actually 004, and that's all related to meals for the convenience of the employer. This is very much a case law-driven test. It gets into a Supreme Court case called the Kowalski test that gets into business necessity. Boyd gave me a Ninth Circuit case that gets some more insight into that. And then the other resources, so those are very specific on those particular topics. The Joint Committee Blue Book is the overall, what does the Tax Cuts Act, Jobs Act look like? And then internally, Moss Adams has put together, I feel like it's a pretty good summary chart of meals and entertainment, fringe benefits. Susan's group put that together, so if anybody's interested in that, subsequent to this, we can certainly provide that. Overall, what I wanted to say about this, though, you have to kind of go, when you do this stuff day in, day out in the tax world, it's Section 162, something's ordinary and necessary business expense, that give it, and then Section 274, take it away is what I say, or puts restrictions in certain circumstances that actually allow the deduction. But most of the time what it does, I say it puts teeth into the overall rule of something, what is ordinary and necessary as far as a business deduction. So getting into employee business meals and meals with clients. Again, that's 2018-76. Again, it's transitional guidance. But the rule exists that essentially, as long as 5 conditions are met, business meals will still be deductible. So to keep that in mind, even though entertainment's gone, business meals are still essentially going to be deductible if you meet these requirements. And a lot of these are substantially similar, but there's more teeth, and I think there's going to be more accounting and there's going to be more documentation on how this actually works. So the first requirement, as I talked about in the previous slide, the expense has to be ordinary and necessary under Section 162, paid and incurred during the taxable year in carrying on any trade or business. So that's a pretty general rule where a lot of things get lumped into that particular bucket. And then 274 says, okay, what are the other requirements that you need in order for it to be a deductible meal? This is kind of a facts and circumstances one. The expense is not lavish or extravagant under the circumstances. Obviously, I think anyone listening or that dictates policy for their business, what does that mean? I mean, there's almost no guidance on that. So I think it's going to be a case-by-case looking at, okay, what's the size of the expense? What is it in relation to the business? What are the facts and circumstances surrounding it? Who attends that particular event, if it's an event, and there are meals provided? But other than that, if you look at the notice, it essentially states the rule without additional guidance. The other thing is the taxpayer or an employee of the taxpayer needs to be present when furnishing the food or beverages. So it can't just be for a client or potential client with no one from the taxpayer present. That's a pretty easy, straightforward rule. But they can be, the food and beverages that are provided can be for a potential or current business customer. So it can be used for, I would say, attracting new clients, for existing clients, consultants, or other business contacts. So that's, to me, a little opening up of the rule. But I think one of the bigger teeth about it is in the case of food and beverages provided at an entertainment activity, and this is where I think there's going to be change for a lot of the taxpayers in a takeaway. If you and your business have a golf outing event or you have a sports facility where you have tickets, that's purely entertainment. Now, if food and beverages are served there, it has to be purchased separately from the entertainment. It has to be clearly documented, has to be stated separately from the cost of the entertainment on one or more bills, invoices, or receipts. And in fact, one of the examples under the notice gives the example of I believe it's a basketball game where the taxpayer attends, meals are provided, but there's no separate invoice. It specifically states in there that that would no longer be a deductible meal expense because it's attached to an entertainment aspect of it. So again, the new act says anything related to entertainment, we're going to throw the baby out with the bathwater. So what we need to do is invoice. And so one of the things I always say when dealing with the IRS or if you're going to go to court is it doesn't matter what the truth is. It matters what you can prove. For those of you that are CFOs, controllers, that are dictating policy, if you have these types of activities, you need to make sure there's separate invoicing, that you can detail out the food and beverages. And in the course of an audit, is there a separate GL account? How was that invoice? Can you pull an invoice and show that food and beverage is separate? Because if you can't, the IRS is really going to challenge that, lump it in the bucket of essentially entertainment, you're going to lose that deduction. But the silver lining is that meals and entertainment are still deductible, and even if they're attached to an entertainment activity, if they're separately invoiced, they're still going to be a deductible expense. And Emily, it looks like we have another polling question here.
All right. Our second polling question, do you anticipate that the loss of the entertainment deduction will impact your business model or change your approach to client management? And your options are yes, no, or I don't know. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We are on our second question today. Give everybody a few more moments to make a selection. And let's go ahead and take a look at the results. Gary, back to you.
All right. Well, that doesn't surprise me at all either. And with this, I think, Susan, I'm going to go ahead and turn it over to Susan, and she's going to get into some more of the nuances of deductibility of different activities. Susan?
Thanks, Gary. So let's talk a little bit about employee recreation and what does that mean. When the Tax Cuts and Jobs Act was first put out, industry thought perhaps everything was taken away because of the entertainment aspect. deduction or non-deductibility anymore. But we've since learned that employee has not really changed. That benefit is still available. But the question is, what does it mean? And are there some other framework issues around employee recreation that you need to be mindful of? And so employee recreational activities for employees are still 100% deductible as long as they're not primarily for the benefit of highly compensated employees. And when we talk about employee recreation, we also include family members in this exception. So family members can join the employee in these recreational events. They have to be primarily for the employees and meet, recreational activities such as holiday parties, annual picnics, or other types of outings. And so those are still good. The question that we really don't have answered is how frequently can you have these types of events? Generally people might have one holiday party, Christmas or something, but if you have a quarterly holiday party, would that meet this sort of deductibility? We don't have any guidance on that. So frequency of these types of employee recreational events is still sort of an open question that we'd like a little bit more guidance on. And then the second piece of this sort of employee recreation exclusion is, do you have a swimming pool, a baseball diamond, bowling alley, golf course? In other words, does your organization maintain a facility that is available not only to your employees, but may be available for other people in the public to use? And those exemptions or the activities are still non-deductible, so it's still a very, very good benefit to provide your employees. And so recreation is still a non-income or deductible expense for the employer. So moving in then to the second piece of this is the meals and recreation. So 274 still allows an exception for the, you still don't receive any type of entertainment deduction unless it's directly related to business meetings of the taxpayers or employees. In other words, you still have some deduction available for expenses directly related to business meetings for the taxpayers' employees or your employees, stockholders, or agents. So there's some allowance still there. And you still have certain activities that are maybe entertainment related, but you'll still get a deduction for those activities. And every situation is going to be a little bit different. So it's hard to say everyone gets X, but you'd want to look at every situation carefully and say whether or not you fit within the guidelines. Employer-operated cafeteria facilities. Gary, did you want to talk a little bit about the convenience of the employee?
I'll go ahead and jump into that, Susan. And there was one more comment I just wanted to mention about employee recreation. We have had a fair amount of questions that ask, well, what if a client actually goes to a holiday party or picnic? Is it going to be completely excludable? And we think the answer is no. We don't have the guidance, but you got to go back to language primarily for the benefit of the employees. So if it's 70% clients and a few employees, I think you're going to have an issue. But the few clients that may attend a particular activity, it probably shouldn't exclude it. So I just wanted to mention that. So the meals provided in an employer-operated eating facility. This is a hot topic for the IRS. I have two slides, and I'm going to get into a little bit of the meat and potatoes of this because I think it's really critical, and I think there's a lot of misinformation. The IRS has taken a hard stance on this, and I think a lot of the concept for businesses, and we see this especially in some of the tech areas where it's employee cafeterias provided, there's good meals, good food, and it's really a benefit of their employees that are working hard, they want a collaborative environment. Those are the arguments that they've made that are for the convenience of an employer. The IRS doesn't necessarily see it that way. And so be aware of that, and I've been through a lot of payroll tax exams on this issue, taking it to IRS appeals, and that's why I'm spending a little bit more time on it. But the basic rules are there has to be a substantial non-compensatory business reason, convenience of the employer. is not, oh, this is a nice perk for the employees. We want them to be collaborative. They work long hours. That in and of itself is not enough. And I would argue you're not going to meet the threshold for convenience of the employer, which I'll talk about in the subsequent slide. It has to be more than 50% of the meals are on the premises for the convenience of the employer. And clearly, obviously, it's going to be an employer-operated eating facility located on or near the business and premises, because if it's for the convenience, it needs to be there. Employer-operated facility during the workday, and it can't be discriminatory, which is a pretty straightforward rule. One thing to mention, we've had 100% deduction for the employer. It's gone down to 50%. And then I wanted to highlight a typo, and I apologize, it's my fault. 0% after 2026. Well, that'll go away completely. So does that tell us, I mean, if I'm sitting there and I'm a controller or a CFO, does that tell us, Gary, what do we actually do here? And I would say, no, it doesn't. What you really need to understand is there's a chief counsel advice out there, and that chief counsel advice is really, even though it's not binding authority, especially if you go to tax court or something along those lines and litigate it, but what it is, it's the lawyers at the national office giving their advice on the existing law and statutes as to how the IRS employees should actually manage and look at this in the course of an examination if they run up against it. And so they've taken a strict enforcement because they feel like there's a lot of abuse there. And I'll give you I like to reason by analogy, and I'll intersperse this analogy with the rules in a real-life example where had a taxpayer who provided meals to their employees. It was somewhat of a isolated location. There was security get into that location. But they provided really, really nice meals. And so one of the things and good IRS examiners will do is they'll research the company. They'll do Google searches. They'll look out. And what the IRS agent did, came into that examination was already had a proposed adjustment in their mind, asked for the documentation through the general ledger, what actually the expense is fairly significant, said, hey, Gary, look, here is 10 different printouts from Glassdoor. And for those of you unfamiliar with Glassdoor, it's essentially where employees can go talk about their input or experience of a particular employer or, how they felt about them. And there was printout after printout after printout saying, oh, they have these great meals, extravagant meals, so glad we didn't have to go get lunch. What a nice perk. Those types of comments. That's what the service is coming into the audit with. So do you actually meet the business necessity? So the statutory history is this section 119. I don't need to get into the depth of it, but if you have employees provided for the benefit of, or cafeteria for the benefit of your employee, you need to read this notice. Because what it gets into is the Kowalski test, which is a Supreme Court case that says there is a business necessity standard or theory that essentially the meals are furnished for the convenience employer if you require that basically the employees need to do this in order to properly perform their duties. Now the cases say employees must accept it, the employer provided meals to properly perform, but really what it boils down to, the IRS isn't as critical on that, but is there a business necessity? Why do they need to do that to perform their duties? And then you have to go and look at, okay, what does that mean? There's a subsequent case called Boyd Gaming, which is a Ninth Circuit case. For those of you who know how, the circuits, that essentially they're a little more liberal. Well, in that case, said, well, the IRS cannot supplant an employer's business judgment as to what is for the convenience of an employer. But what we can do is we can issue guidance, and the things that they said is, okay, what is necessary to perform the duty? Where's the location? Do they have to work long hours? Do they have short meal periods? What are those requirements? And then once they have those and they can articulate those, there needs to be specific policies related to the employer's business needs and goals, and they've been adopted, and that they've been communicated in some form or fashion. So a lot of times there might even be this internal policy, but it's never been written or adopted. So even if you can meet those thresholds that there's long hours, there's not a lot of options, we have a short meal period, we have these different issues, there needs to be a policy in place because the IRS is going to look for it. It needs to be provided to employees and at least articulated and communicated. Because if you don't have that, you're going to lose this on exam, and you may win it on appeal, or if you go to litigation or pre-litigation, but by just having that policy in place and having it clearly articulated is going to give you a much greater chance of success. Non-compensatory business reasons, again, I'll go back to my particular example. On that example, the taxpayer had security, a lot of intellectual property. It was in kind of a work place environment where there's nothing really close. In fact, there was nothing within walking distance. There was nothing within 2.5 miles, and they had a short lunch period. So I had to dissuade or write up our position that, yeah, maybe this is a nice perk for the employee. They're good meals, but we have intellectual property. There's security to get in and out of the gate. They only have 45 minutes. There's nothing in walking distance. For all these different reasons, we were able to articulate an argument and say, okay, this is our policy. We had a written policy. They needed to perform their duties. And because of that, we were successful down the road. But be aware of that because the service is going to come after this again and again and again. And this is actually, out of all the notices and the guidance, this actually has the most detail. I mean, it talks about the committee reports, the theory, all of those things. And I would say if you have that, take the opportunity to review that, look at the requirements. If you have questions, we're happy to follow up with that. And with that, I want to turn it over to Susan to get into some of the meat and potatoes of parking, commuter, other benefits that are out there.
Great. Thanks, Gary. And before we leave the convenience of the employer, I just want to add another sort of element to this, that the deduction for restaurant employees or restaurant businesses did not go away. That if you furnish meals to employees during your shift for restaurant workers, that 100% deductibility is still available, which is important. So just as a quick area, Gary and I have talked about the changes to fringe benefits and deductibility that employers are facing, or the non-deductibility of certain aspects. And we believe that the IRS will probably be focusing on this area in the next year or two and looking at policies, procedures. And so when you look at these types of things, be kind of mindful of how you're applying these rules and types of employees you're actually benefiting. So with that, let's move on to fringe benefits. And here's just a couple of overviews. If you provide parking, commuter benefits, transit, if you provide bicycle commuting benefits, moving expenses, and I know a lot of organizations do provide moving assistance for their new hires so they can encourage them to come. And then employee achievement awards, if you offer those types of awards. There are some limitations and some additional framework on what those awards and what those things mean. So moving into qualified transportation fringe benefits, this is a very large area that changed for employers, not as much for employees in the for-profit world, but it certainly changed again in the not-for-profit world, qualified transportation fringe benefits. And so looking at the information, this is a little bit harder to see perhaps, but this is actually from one of our internal manuals we put together, and looking at the qualified transportation fringe benefits, and we talk about the old law versus new law and some of the changes here. And let's just talk about what's happened now. Currently, qualified parking, transit benefits, and other types of opportunities you give to your employees, excluding bicycle reimbursement, those are still a non-includable amount in employees' compensation. So no changes to the employee. What has happened in businesses, however, is that these transportation or deductions are no longer available. And so that causes, I don't think that we've seen too many changes. Employers have not really changed their approach to these types of benefits that we are aware of. They're still having this exclusion for employees and providing the benefits. It's just the employers no longer get the benefit of the business deduction. So that hasn't been a huge change. For those clients and probably folks that thought perhaps you could continue to possibly do a pre-tax deduction sort of do a workaround on some of these transportation benefits, the IRS came out with specific examples about how a pre-tax deduction and a benefit is not allowed to sort of circumvent these rules for an employer non-deductible benefit and an employee exclusion. So it's just to be aware if you've got additional questions and want to see the specific exemption, it's the IRS publication 15B will provide additional commentary on that. Bicycle commuting costs are, of course, no longer allowed as an employer deduction. That's, the employees don't get an exclusion. It's just gone for a period of time. Moving expenses, I think this has been another area for certain employers trying to attract employees, et cetera, and help them with moving costs. This is no longer excludable from employees' compensation. So it's taxable income to the recipient. I've had questions on this particular benefit exclusion, and one of the questions was, well, what if I pay for my new employees' moving expenses and I don't take a business deduction? Is that okay? And the short answer is no. You need to include that as compensation for your employee. So you can't exclude it and not take a deduction. That's not really how the rules, are working on this particular one. And employee achievement awards. I think the biggest thing to know here, and the biggest item to really take away, is the idea that the IRS clarified their perspective on what is tangible personal property. And, previously to this type of clarification, I think some employers or companies thought that giving a cash card or a prepaid card or some type of gift card was not really cash, and it wasn't taxable. It was just here's this this little benefit. The rules came out and they basically said any type of gift card is considered cash, and that is tangible personal property and is taxed as such. So just as a by the by, if you can actually calculate it, you can track it, it's taxable. It's probably not a de minimis benefit unless perhaps it's very infrequent and it's very, very small and it's difficult to account for. Otherwise, the rules basically, you account for everything and it's a taxable benefit unless there's an exclusion available. So going on to a polling question, Emily?
Great. Our third question, do you have accounting systems in place to properly account for meals and various fringe benefits in order to comply with the new legislation? And your options are yes, no, or I'm in the process of implementing. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Give everyone a few more seconds here. And let's take a look at the results. Susan, back to you.
Great, thank you, Emily. And so again, this is good news. I'm assuming that most people on the call already had systems to manage or account for certain meals and fringe benefits. And certainly with the change in the law and how you kind of manage fringe benefits, this would be an important area to sort of focus on and to really look at how you're managing your tax benefits and deductions for the business. This is going to be, Gary and I believe this will be an area of focus for the IRS in probably the next year or two. And we're already seeing more audits in the fringe benefit area for clients. So let's talk about guidance on qualified fringe benefits. So notice 2018-99 provides guidance for taxpayers to determine the amount of parking expenses for qualified transportation fringe benefits that's non-deductible under Section 274. And this is, I look at this as a slightly unintended consequence of the qualified transportation fringe benefit no longer being allowed as a deduction for the employer. And what this notice talks about is how you look at the expenses for qualified transportation fringe benefits that are no longer deductible by the employer as a result of having these benefits provided by an employer to their employees. So this is interim guidance at this point in time, and it's one of those areas that you can rely on the method for an allocation of expenses, and the notice also takes into consideration certain methodologies or methods that they believe are unreasonable. So we think that this guidance it's reasonably good guidance, but it has a whole bunch of open questions that we really don't have great answers for. So we are looking at this guidance, shall we say, with a little bit of this will be helpful. When we look at how the notice is set up, there are two main areas that the notice sort of separates. The first area of the notice is where the employer pays a third party for employee spots or for parking, and it's not included in the lease. And the second area is where the parking expense is in the lease, and it's not separately broken out. So one of the areas that Gary touched on earlier in our presentation was expenses for entertainment and what those expenses might be if you were to go to a sporting event or some other type of outing where the cost of the venue is just a one-line item, it's X dollars. And if you can identify meals or other types of expenses, advertising, for example, that may be part of that overall cost, then you may get additional deductions or other deductions that may be available. So we are using a similar analogy to leases when it comes to buildings, and that may offer as part of the lease expense parking that may be used by your employees. So at this point, it's a little late to go back to your lease management company and say, gosh, we need you to break out our parking expense or what you think is allocated to our parking for purposes of what we can or can't deduct on our tax return. So we think that'll probably be one of the things, companies and employers will start asking their leasing companies is, can you break out or can you help us with parking costs so we can understand what that means to our deductions. And so for notice 2018, where an employer pays for employee spots, there's a disallowance of the total costs for employee spots. The monthly limit, as I'm sure everyone knows, there's a monthly limit that's indexed by the IRS, and the monthly cost is $265 that's excludable from employees' income. If the cost of the parking is more than $265, this notice indicates that the excess is considered compensation and should be included as wages to the employee. I think this will be a very difficult analysis to make, certainly in a timely basis this year. So it's just enough to be aware that if your cost for parking to the employee is more than the monthly amount, it should be added as compensation. I haven't seen a lot of that yet. Gary, have you seen this third-party situation come up at this point in time? It'll probably be more possibly prevalent in metropolitan areas. Possible.
I think we're going to really see this on exam probably, more 16, 18 months out. But I can see the IRS already ramping up to try and say, okay, we're going to analyze this. And as we get into payroll tax exam part in a few minutes, I'll talk a little bit about those examiners and their kind of methodology.
Yeah, thank you. And I think that so that's sort of maybe not problem number one, but it's a concern. And then the second piece of this is the employer leases or owns all or a portion of the parking. And so you want to ask yourself the question, is their line item? We just talked about that. Is it for the sole use of employees? Do you share the use with other tenants in the building? Are the reserved spaces for executives, clients, or employees only? And so these are the questions, some of the questions you are going to need to ask yourself. We will be releasing, probably within the next week or so, an employer alert regarding parking and some of the things that we are looking at and what we think would be important considerations for this element. We also suspect that with this notice and methodology that there are going to be gaps in people's clients, companies, business returns where this may not be this may not be a huge consideration, but there is in this notice 2018-99 a four-step methodology deemed to be reasonable for calculating the expense or non-deductibility of parking. And to calculate the disallowance, you need to consider, you need to understand if you've got reserved employee spots. You need to determine the primary use of the remaining spots within your parking. Calculate the allowance for the reserved non-employee spots, and then determine remaining use and allocable expenses. And before you can do any of this four-step methodology, you have to actually understand what the cost of maintaining the parking facility area is. This is going to be almost, for those people who actually lease spaces, almost impossible to figure out what this disallowance or non-deductibility might be. So we're basically suggesting to employers and clients that they can go back to their leasing or management company and ask the question, get a little bit of assistance or guidance, and then kind of work through some of these details. We think this is going to be an area that will be looked at, but we're hoping IRS will give us some leniency for this year since this notice came out so late in the year for what employers need to do for parking disallowance. So this is just a little bit more information about the imputed income and monthly allowance exclusion. And in the essence of time, we're going to qualified moving expenses. So the qualified moving expenses. Go ahead, Gary.
Oh yeah, go ahead, Susan.
Well, I'm just going to say the qualified moving expenses. We quickly touched on that, and basically, it's an employee wages, and it's non-deductible by the employer. So I think it's going to be a more expensive for employers to help employees move because they want to give this assistance. And so the employers, clients I've worked with, have been grossing up income, which turns it into another about 30% cost with the additional tax piece of that. So it becomes a little bit more expensive to provide moving assistance for employees or people, prospects you'd like to come join your organization. Gary, do you have any other comments?
No, I think that, it's a fairly straightforward rule. It's going to be more of grossing up to move forward with it.
Yeah. And the Notice 2018-75 provides a little bit of relief here we know that moving expenses are no longer deductible after January 1st, 2018. However, this notice says if you do have moving expenses that were qualified prior to January 1st, 2018, and those expenses were paid or reimbursed during 2019, you will still get a deduction for them. So that was a nice sort of give me back. So just document your expenses, and if they occurred prior to January in 2018, even though they were payable in 2018, you'll get those deductions on your business return. I think I said 19, but it's 18. So, Emily, polling question. I think this is one of our last ones.
Yes, our final polling question. Now that the Tax Cuts and Jobs Act is a year old, has your company changed the benefits package offered to employees? And your options are yes, significantly, somewhat, only moderately, not at all, or in the process of reviewing benefits and costs. And once you have completed all CPE requirements today, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. And I'll give everyone a few more seconds. And let's take a look at the results. Susan, back to you.
Great, thank you so much. So yeah, so that looks about right. So let's go into some practical business application considerations. And we're just going to quickly run through a couple of these, and then we're going to move on to payroll exam. So we believe that companies should be reviewing their benefits package, and this is across the board for all the benefits offered and how those deductions may or may not be captured in your internal record-keeping systems. Look at your current expense platforms. Make sure they're capturing the right information and documentation. Employee education for those individuals in your organization that are actually looking at expenses, so they can actually ask the question, is it deductible or not? And if it is, do I get 100 or 50%? Also knowing that some of these expenses are going to sunset and they will be going away. And then rewrite employee policies and expense notifications to employees as appropriate to make sure you've got correct documentation. And with that, we're going to move into payroll exam, and Gary will tell you why it's important to document your information.
Great. No, I think, Susan, thank you. That was a great transition, that last slide. I'll go back to my famous quote, it doesn't matter what the truth is, it matters what you can prove. And that is so true in your policies, and how can you prove 3 years down the road how you actually expense things and can you track it. I think it's going to be more and more critical. What I wanted to cover on payroll tax examinations is a little bit about payroll tax examiners. Oftentimes, you're going to get a payroll tax exam out of an income tax exam. We'll see an income tax examiner come in, look at the routine issues, books and records, may notice a particular issue, and then call in a payroll tax examination specialist. And one thing I always do when I get a new exam, and I'm giving people advice, I say, is this an SBSE examiner or is it LBI? SBSE examiners are small business self-employed for taxpayers with assets under $10 million. Generally less sophisticated, not always true. LBI is large business and international. Many of them start out as SBSE and go to LBI. The difference with payroll tax examiners is they're actually under SBSE, but they're generally former LBI examiners. They just happen to be under the umbrella. They're very sophisticated. These are the only types of exams that they look at. They understand the notices. They understand the issues. They understand the IRS's position. So they're going to ask for a lot of information. So know that going in, you're going to deal with someone that may not, sometimes you can get a green examiner and it's easier to work through the issues because they don't have the institutional knowledge or the background or understanding. But when it comes to payroll tax exams, that's going to be a tougher road to hoe. So when we talk about statistical samples, I would say one thing when you get a document request is always challenge it. All IDRs or information document requests are subject to negotiation. So push back, challenge sampling. Susan and I have done that on different ones. Where clients haven't done that, sometimes they're pulling a lot of information at a lot of expense in order to get the IRS an answer that we might have been able to get to with sampling. So keep that in mind. The other thing I always want to articulate is if you're going down the path of an unagreed case, and the next slide I'm really going to talk about that, you always want that opportunity to sit down with the manager. And the other thing that I've found is you're always going to get sometimes one more bite at the apple. Some managers rubber stamp the lead examiner. Sometimes they don't. But when you have a challenging examiner, I always say bring in the manager to try and resolve that thing at the lowest level possible. And I think I've found in general, and Susan would probably agree, that payroll tax examiners generally have more discretion to resolve cases than a regular examiner. So we've had some pretty good settlements short of appeals just through the exam team, and that's why the manager is important. I'm going to kind of skip the last two because what I really want to talk about is a couple critical things in the unagreed cases. We're continuing to have unagreed cases, and that's where you get to the end of the exam and you can't agree on resolution, so you're headed to IRS appeals. So I'm always pushing people to not bid against themselves, meaning wait until the service has gotten to a point, they're going to call up and say they think you have a position, but wait for them to articulate their position in writing, get their notice of proposed adjustment. That way we can evaluate it, see what law they've used before handling our response, because I think that's very, very critical. And it will save you a lot of heartache, and you don't want to bid against yourself, I always tell people. One of the critical areas are the acknowledgement of facts, and that is a new document request that comes out at the end of the exam. This is out of a new appeals policy, and the IRS is going to come to you near the end of the exam and say, they're going to write up their version of the facts and give you an acknowledgement of facts IDR, and in the interest of preserving your ability to argue that case, you need to pick through that and disagree or agree to disagree with anything you don't like or think should be interpreted differently. The easy way out is just to read it and go, okay, that's somewhat accurate, and agree. And then that becomes the ending, all the facts in the case. You don't want to do that. I mean, there's an argument there's no legal requirement to even have to respond. However, you want to understand it's their version of the facts. And this new AJAC policy of appeals says we will not look at new facts at IRS appeals. AJAC stands for Appeals, Judicial Approach, and Culture. We're going to be there as an administrative law judge, and we're not going to look at new facts. So if you don't have good facts, you don't bring them all to the table on the exam and close it out, and then try and bring new facts at appeals, they're going to look at it, send it back to exam, and you're going to cost yourself 6 to 9 months of heartache. So remember to really look deep at that and get everything in the file and have a complete file. And more, the exam teams are wanting to go to pre-appeals conferences. My comment on that is allow them to do it. There are no ex parte communications at appeals, meaning they can't talk to the examiner without our presence. If they want to go to a pre-appeals conference, I let them put up their PowerPoint, have their discussion. I say nothing, and then I wait for them to leave the room so we can have an objective conference to try and settle the case. And we're seeing more and more of those, so be aware of that if they ask for that. And my suggestion is to let them speak and wait for our opportunity to respond. Last little thing, and we've covered a lot of these, but a lot of the things we're seeing are worker classification, i.e. should you be a 1099 versus a W-2, reasonable compensation, continues to be an area both in the C and the flow-through, especially the S-Corps. I think you're going to see more of this with the new legislation out there. So that's with payroll tax exams. That's a factors analysis. We've already talked about per diem, meals at cafeterias, fringe benefits. All those things are on the table. But remember, any level of compensation or anything that smells like compensation, you're going to get document requests in order to look at that. So please be aware of that. And Susan, is there anything else you would add to that as far as the overall exams that we're saying, or do you want to jump into accountable versus non-accountable?
You know, what we're really seeing and what is slightly concerning is where the IRS comes in and they start looking at one area of the business, and then the relationship, if you will, kind of morphs or takes a different direction, and they really are looking hard at payroll, fringe benefit, and the opportunity the employees have of getting a benefit for a non-taxable event, which kind of leads into this. We just want to remind people that this has been around for a long time, but what we're starting to see is the accountable versus non-accountable plan situation. And this just tells you that in an accountable plan, you need a connection, substantiation, and any return of an advance or excess money that is not being able to be substantiated. And the biggest area that we see in this sort of situation is auto allowance, where it seems like it's a great idea to give some of your people who are on the road doing things an auto allowance, but we're not seeing that critical issue come back to the employer, which is substantiation of the expense. And Gary and I were involved in a very, very large auto allowance exam, and the client did not prevail because of the failure of substantiation piece. So this is just a reminder, this did not change. It's still really important. And I think our last takeaways, I'm just going to quickly put these up here, is, sorry about that, do this again, is to, understand what you're looking at, apply your changes to the individual and business returns, make sure you understand what exam triggers are out there, and then document or substantiate, your information. Gary, do you have other, sort of?
Yeah, the only thing that I would add, and I tried to highlight at the beginning, is those notices are very, very good authority. They provide a lot of information. If you follow those in theory and can substantiate your positions, you're going to have a good chance of prevailing on exam. And with that, I think we're at the end of our material.
Yeah. Emily?
All right. We are right at the top of the hour. Thank you, Susan and Gary, for a great presentation today. Unfortunately, we did not have time for questions, but we will do our best to follow up with you after the webcast, or you may reach out directly to Susan or Gary. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts widget to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.